Okay, awesome. Let's get started, Nicole. Okay, so good afternoon, everyone, and thank you so much for joining us on one of our first webinar series at MadeComfy. The aim of these webinars are to bring experts in industry to come in and tell us and advise our property owners about the best ways to optimize their Airbnb. So today we have Nicole from Tax Tank, and we're looking into the ATO's watch list and maximizing your short-term rentals tax return for 2025. As you know, the ATO are all over our property owners quite a lot of time, so it's great to bring in our experts to come and tell you the best way to optimize your Airbnb. So the best way to get kickstarted is to explain who I am. So I've just recently joined MadeComfy about a couple of months ago to join the team in the partnerships, sort of strategic partnership division. We're looking to bring in the best in the business and to optimize our service through our partners across Australia and New Zealand. Today, we've got Nicole from Tax Tank, and I will let her explain who she is, what she's about, and what she's going to explain today.
Thanks, Tom, and hi, everybody. My name's Nicole, and I'm a registered tax agent and tax planning specialist, and also the founder of Tax Tank. So thank you for having me. Today's session is all about helping MadeComfy's community of short-term rental investors and anyone else joining us feel more confident navigating the ever-evolving world of property tax. The goal is to demystify what's really going on with the ATO's latest compliance activity, and also cover some of the most commonly missed deductions, the ATO hotspots for 2025, and most importantly, how to reduce your risk. Because let's face it, short-term rental investors are under more scrutiny than ever. But before we jump into the fun stuff, yes, tax can be fun. Let's start with a little context. Why are property investors so often in the ATO's firing line? And just how advanced is their data matching capability? And the big question, what are they really doing with that information? So firstly, why does the ATO target property investors? To answer this question, let's step back to 2016 when the ATO launched what they called the Random Sample Program. This program was designed as a strategic initiative to estimate the so-called tax gap, which is basically the difference between what the ATO thinks it should be collecting and what they are actually collecting. To explain how this program works, the ATO randomly reviews 1,089 individual tax returns over a 2-year period. So that's about 545 returns each year. Now, out of those, only 116 returns belong to property investors, which is just over 232 in the 2-year period. So when this program first commenced, I should say, the ATO claimed that 9 out of 10 of those 232 property investors had errors. A headline that's been regurgitated every year since and somehow never improves. Not only that, from this tiny sample, the ATO extrapolates the tax gap, which was and still is estimated to be 1.2 billion for property investors. Now, considering there's over 2.2 million property investors, whether or not that sample size is statistically sound is completely debatable, especially since it hasn't even been scaled with the population. And there's also no adjustment for the impact of poorly implemented tax changes like travel and depreciation restrictions, which have likely distorted the figures. Nonetheless, the ATO has been using these results to justify a pretty aggressive compliance approach on property investors ever since. That includes, but not limited to, a massive investment in data matching programs, automation, and ongoing audit campaigns singling out property investors. Which brings us to our next slide, just how extensive is the ATO's data matching capabilities? Well, the ATO now collects data from over 600 sources. Terrifying, right? And yes, they're absolutely using it. On this slide, we've listed 10 of the key sources that impact property investors, especially in the short stay space. But let me unpack a couple of them because the level of detail the ATO collects is far more extensive than people realize. Let's start with the favorites, the banks. Amongst other things, the ATO has full access to your loan data, how much you've borrowed, how much interest you've paid, what you've withdrawn, and whether the loan was used for investing or something else. They're using it to check if you're overclaiming interest deductions or failing to apportion personal use. And this is especially relevant if you've refinanced an investment property to pay down your home loan or withdrawn funds for personal use. In both cases, you can't claim the full interest anymore, even if you pay the money back later. The moment that money is used privately, that portion of the interest stops being deductible for the term of the loan. That's why using offsets is often a good strategy, but we can chat more about that later. Now let's talk about short stay platforms. It's no surprise that Airbnb, Stays, and Booking.com, for example, are all required to report host income, guest details, booking dates and durations, etc., straight to the ATO. But from the 1st of July 2024, things escalated significantly. The new sharing economy reporting regime requires platforms to report income quarterly, even for a single booking. And here's where it gets interesting and somewhat risky. The ATO isn't just looking at what you've earned anymore. They're now assessing whether your property is genuinely available for rent. For example, if your calendar is frequently blocked out or you're slow to respond to guests, they can argue it's not truly available for rent and disallow your deductions for that period. They're now even analysing listing behaviour and platform engagement patterns to assess rental intent using their own ATO data models. And then there's utilities. This is the quiet one that people forget. The ATO get data from electricity, gas, and water providers, and they use it to determine actual occupancy periods. For example, if your electricity usage suggests the property was occupied during times you didn't declare rental income, or conversely shows minimal usage when claiming it as your main residence, that discrepancy can raise a red flag. The ATO also uses data to assess eligibility for the main residence CGT exemption and the 6-year rule. By analysing connection dates and account activity, they can reconstruct occupancy timelines. If the dates don't align with your claims, they may challenge your CGT exemption, either in part or full. And if that isn't enough, the latest evolution is the ATO's use of AI across its 600 data sources. This means it's no longer just about reporting rental income correctly. It's about making sure your entire tax position, especially around longer term events like CGT or even property changes of use, is backed by consistent verifiable records. So on a happier note, let's move on to the ATO hotspots and where investors are getting caught out. Rightly or wrongly, the ATO claimed that 90% of property investor tax returns contain at least one error. So let's have a look at where most of these issues are happening. The first one, the ATO say that 29% of errors relate to interest deductions. So as I mentioned earlier, this is an easy target for the ATO given their direct access to your bank data. But most mistakes aren't deliberate. They usually stem from incorrect apportioning or misunderstanding that repaying a loan does not restore its deductibility. For example, if you took out a $500,000 loan for a rental property, which was paid down to $400,000, and you withdrew the available $100,000 to maybe buy a car or a holiday or both, and then paid the $100,000 back later, it's still considered private use. So only 80% of the loan can be considered income producing, which means 80% of the interest and bank fees are deductible. And that's why offset accounts are a popular choice, because moving cash in and out of offsets generally does not impact the loan usage, which ensures that the loan retains its deductibility. The ATO also claimed that 15% of errors relate to gross rent. Now, these errors aren't just related to, I suppose, gross rental income from any platform or source. It extends to non-declaration of other things like insurance payouts, reimbursements, and even the sale of secondhand assets previously depreciated, which the ATO still considers accessible. And of course, all of these agencies are part of the ATO's data matching regime, so there's no getting away from it. Next, the ATO claimed that 14% of tax errors come from capital work claims, mostly due to confusion between repairs and improvements. To clarify, repairs are about restoring something to its original condition, like replacing cupboard doors or swapping carpet for carpet. Repairs are usually claimable as an expense in full, and so too are things like painting. But if you're upgrading or improving, like replacing whole kitchens or switching carpet to timber floorboards, that's a capital improvement and it must be depreciated over time. Another common trap for investors is repairs made just after a purchase. If the property needed the work when you bought it, the ATO treats it as part of the acquisition costs under the initial repair rules, which means the costs are considered capital in nature and need to be claimed at 2.5%. And last but not least, 40% of errors relate to general deductions and poor record keeping. This includes overstating deductions, claiming things not deductible like travel, misapportioning or claiming expenses while the property wasn't generally available for rent. But sadly, the number one reason these claims get disallowed, according to our friends at the ATO anyway, is missing or inadequate records. So even if the deduction is 100% legitimate, if you can't prove it, it's gone. And it's not just keeping records for 1 year either, it's keeping records for 5 years from lodgement, or when the property or other investments are concerned, from purchase to 5 years after the sale, which could be a very long time. Okay, now for some even happier news. Let's talk about deductions, because here's where a lot of money gets left on the table. A lot of the deductions from this slide are pretty obvious, but I want to talk about 3 in particular that cause the most amount of problems. First, borrowing expenses. This is hands down one of the most commonly missed deductions. Things like loan application fees, lender's mortgage insurance, mortgage registration fees, and title searches. They're all deductible, but generally over 5 years from the start of the loan. And they need to be apportioned for any personal draws, personal usage as it relates to share properties, in the same way as interest and other expenses. But what many investors don't realize is that if you refinance a loan, even in the first year, any residual balance of the original borrowing expense becomes fully deductible. It's not lost, and it could be very significant, even if lender mortgage insurance is involved. And of course, any new borrowing expenses starts the 5-year claim again. Second, depreciation. Depreciation is one of the most powerful deductions available to property investors, but it's also one of the most commonly misunderstood, especially for short stay or part-time rentals. In short, you are eligible to claim depreciation even if you use the property personally for part of the year. Your depreciation claim just needs to be apportioned based on usage. So if 100% of the property is rented for, let's say, 310 days, then 85% of the depreciation can be claimed, even if the assets are used exclusively in the rental space. What's important to know is that if your usage changes from year to year, say 1 year it's 85% and the next year it's 90%, your claim must be adjusted each year as per the eligible claim percentage. It's not a set and forget deduction. If you purchase a second-hand property after May 2017, you generally can't claim depreciation on existing plant and equipment items, things like ovens or carpets or air cons. But you can still claim capital works, which is the building and structural improvement on properties built after September 1987. So it's always worthwhile to get a depreciation schedule. Any new assets you purchase after settlement are depreciable either way, and you don't need a new schedule to claim them. And of course, any replaced items can be fully written off in the year of disposal, and that includes furniture. So speaking of furniture, if you're furnishing a space used exclusively by guests or tenants, for example, a guest suite or a short stay unit, the items in that space, like the bed, the couch, or the TV, are considered fully eligible for deductions. So you don't need to apportion the asset itself for personal use, but the deduction is still limited to the portion of the year the space is rented or available for rent. To use the same example, if 100% is let or available for let for 310 days, then 85% of the depreciation will be claimable. And last but not least, platform and booking fees. Any fees you pay to Airbnb, stays, or other booking platforms, whether it's a service fee, a transaction fee, or a processing charge, are 100% deductible. No apportionment is needed because these costs relate directly to the income. This also includes cleaning after short stays, consumables, guest amenities, and even tariffs, which are imposed, I suppose, implemented by platforms themselves. Property management fees are also deductible with no apportioning needed. Even better, using a professional service like MadeComfy helps demonstrate that your property is genuinely available for rent. And that matters because we now know the ATO considers intent when assessing your eligible deductions. But here's the best part. If you're looking at this list and you're thinking, God, I've missed a few of these, you can go back and amend any tax return lodged in the last 2 years. If you don't have a depreciation schedule, those are also backdatable. So I'd suggest contacting someone like MCG Quantity Surveyors, who guarantee any claim will outweigh the cost of the schedule itself. So definitely worth checking out. Which brings us to our next slide, how to reduce audit risk and stay ahead of the ATO. So reducing your audit risk comes down to 3 things: keeping accurate records, knowing what you can and can't claim, and most importantly, understanding how and when to apportion deductions. So it might sound complicated, especially for those new to property investing or with multiple properties, but the good news is it doesn't have to be. There's a smart text tool like TaxTank to automate your tax compliance, handle apportioning, and provide complete visibility across your whole property portfolio. no matter how the property is owned or used or how often things change. So what is TaxTank? It is essentially a cloud-based software. It's something that me and my team have been building for about 5 years now. And it's designed especially for individuals, not just accountants, to take control of their property tax and stay compliant year round. With our Property Tank subscription, live bank feeds capture every rent payment expense in real time, so nothing is missed. We've built in functionality to address all of the ATO's targeted areas, from automating borrowing expenses, loans, depreciation, and capital works, to handling income and expenses for short stay, accommodation, and shared properties. If a property's expected usage changes, it increases or decreases through the year, we have TaxTank smart tools and portfolios to make that simple for you to manage. You can just use the apportioning calculator to update the claim percentage, and the system will automatically update all of the deductions throughout the year. And if a property's purpose of use changes, say your home or a full-time investment turns into a short-term rental, you can easily move properties in between portfolios, locking in important dates, real-time market values thanks to our CoreLogic integration, and even the right tax rules, so nothing gets missed or overclaimed over the years. So amongst other things, TaxTank produces ATO-ready reports, acts as a permanent document storage, and you can even invite your accountant to eliminate those end-of-year tax hassles. See, I told you tax would be fun. But seriously, from like $15 a month, it's an easy decision to go digital. And there's also a 14-day free trial and a special MadeComfy offer that's available after today's session, right there now, actually. So that brings us to the end of this presentation. So it's time to hand back to Tom to take us through the Q&A.
Well, thank you, Nicole. That was awesome. We had so many good insights, and the reason for why we're doing this webinar is we get so many inquiries from our property owners with regards to what's deductible, what's not deductible, and there's a lot of complexity around it. So it's great to get you TaxTank's like insight into that, and hopefully all those attendees today, we will get the recording after, and we can go through it. You can really listen to it all and apply it to your tax return coming up this end of 2025. Throughout, we had many questions with regards to previous questions that our account managers have been asked by some of their clients. And we've also got an anonymous attendee question, which is a very specific question, which we can go ahead and answer. We've got about 5 to 10 minutes to answer Q&A. So guys, if you have any questions at all, please fire them into the comments and we'll answer them on this call as quickly as possible and to a high level of detail as possible. So I guess let's start off with the with the attendee who has said this question on screen. Nicole, I guess you can see it, but I'll read it out for you if not. So basically, if the property is vacant and an agreement has been made with a property manager, like MadeComfy, but the property is still waiting for council approval, the DA approval, when sort of with the sort of expenses incurred, so the utilities expenses in that period of time, can you basically claim back? So from the date of the agreement with the property manager or when the property is first advertised?
Yeah, so the ATO says when the property is genuinely available for let. So it doesn't mean that it has to be let all the time, but it has to be genuinely available. So if there's no DA approval at that point in time, then the ATO would argue that that property is not genuinely available.
Okay, so let me know whoever wrote that question in. I can't see who it is, but if you want to follow up, my email's on screen. I can put you into contact with Nicole directly to help.
Yeah, and I think the important, just to elaborate on that a little bit more. So in those circumstances, any of those expenses incurred, prior to that time that the DA was in place, they're all capitalized. So they're all part of what the ATO considers a holding cost, and they should all be captured, and obviously they form part of the CGT calculation if that property is ever sold in the future. So important to keep track of. Okay,
that's great. That's great insight. I hope that clarifies. You've just shown that it does, but hopefully that does clarify everything you're wondering and querying. We had a couple questions previously sent in from our hosts and our property owners. So one I think you briefly touched on was, can you claim back land tax? And I guess you can claim it back for the last 5 years you sort of mentioned, or is it, you can clarify on that?
Well, land tax is an expense. So land tax is often confused with capital expenses, or even sometimes even that borrowing regime about 5 years. But land tax is fully deductible in the year you pay it. So there's no need to capitalize it, and people sort of often confuse it and then try to incorporate that CGT. But land tax isn't cheap, and it's certainly a nice big deduction to make sure you include.
Awesome. Okay. And then I hope that clarifies that for you, Jack Lundberg. And then we had a question from Sam. He's one of our favorite property owners of our team. He basically asked, with MadeComfy, you sometimes can meet your account manager in person, especially if you're near them. Can you sort of claim back travel with regards to your Airbnb? So you sort of briefly touched on it, but if you could explain that a bit more for me.
No, the ATO removed that a few years ago. I think 2017, I think it was. So it's a blanket ruling, which is quite unfortunate for people that were doing the right thing. But travel under any circumstance for property investors is no longer claimable. If you're in the business of property, yes, but property investors no, and that includes body corporate meetings. It includes even going to see your accountant if the advice is property related. So yeah, definitely something to be aware of, but unfortunately, there's no exception.
Understood. Hokim just mentioned as well. So at MadeComfy, our clients get the opportunity to use their properties when they want to. Well, for 6 months of the year. Okay, so not time people come back for Christmas, they want to use their property. The core question is, are the cleaning fees for the owner stays tax deductible and proportioned according to the number of days the owner stays in that property throughout the year?
Well, no, not necessarily, because cleaning fees and things don't need to be apportioned. So if you've got a share property, you know, when your tenant leaves, you've got that cleaning, that doesn't need to be apportioned because it's directly relatable to that income event. But if you're in the property yourself, then the cleaning fees essentially would not be deductible because they're not attributed to income producing.
Could you argue that they're getting the property clean for the next guest to go into it, and that's a business expense?
Look, I suppose it's all in the packaging, isn't it? But yeah, if the property is vacant per se for a period of time, then obviously the property would need to be cleaned before new tenants moved in. But yeah, look, it's sort of that general logic with regards to what is part of the income producing and what's not. And also the apportioning component. You know, if some of these things like interest, for example, need to be apportioned.
Okay.
But yeah, direct expenses, it's probably more valuable to keep them related to the incoming stuff and exclude the personal stuff.
All right, understood. I hope that summarizes and answers your query. Let me know if it doesn't, we can fire away. And then there's one last question we had, because obviously, as I mentioned, our property owners use it themselves. So probably actually very similar to Ho, but with regards to are you able to claim back the utilities when you use it? But because obviously you basically said earlier that the ATO matches and tracks the use of utility bills within the property. So I don't know. I mean, a lot of our property owners will probably think, how accurate are these tracking events?
Yeah, well, you'd be surprised how much information. I mean, I sort of touched on a few points, but it's really much more than that even. But with regards to utilities, remember that there is a percentage of claim that will be calculated for that property for the year. And that will be based on whether or not the property is used for the whole year or part of the year, and whether it's the whole property or part of the property and those common areas. So there's a calculation which TaxTank does automatically as well, but it will calculate what your claim is based on those metrics. And that's generally what's used for things like electricity when you're claiming the deduction component. So if it's 68%, for example, then that would apply to a lot of those different expenses. The things that aren't specifically related to a specific income, like, you know, booking fees or platform fees or cleaning.
Okay, understood. That's awesome. So yeah, that's great. I think, look, there's no more questions on the chat at the moment. I've got no more from our team, but please, guys, far away now. We've got another couple of minutes left. But I guess one really cool thing you've highlighted is a lot of our property investors have bought with our furniture partners to furnish the whole property. A lot of units come out furnished, we do it all for them. So all those packages are, so which is great. So if they haven't claimed it yet, they can go back. They have all of the invoices laid out and they have all the packages and the prices. So Nicole, just to clarify, they can go back for the last 2 years of deductions.
Yeah, and it's not necessarily the last 2-year return. It's it's any tax return lodged within the last 2 years. So if you missed something, then definitely worthwhile to go back and claim it. Things like furniture packages where you've got fixed costs, you wouldn't necessarily need a depreciation schedule for. But if it's something bigger or even the building component, then definitely worthwhile to max that out. And then depreciation companies will take into consideration the furniture package costs and things when they're producing that schedule. You know, that the schedules, yeah, that they'll always sort of vary over time, but it's always a nice starting point, and can also be backdated. So if you haven't claimed it yet, you haven't completely missed out.
Awesome. Okay. Right. We're coming up to the end of the webinar, guys. So fire away any questions you have. If not, please do make use of the sort of promotional perk we have at MadeComfy and for our property investors. The software is great. We can even from your dashboard download the invoices and plug it into Tax Tank for you. Look, it's a great session. Please email me with regards to any sort of tax queries you have. Nicole's already reassured me that she's happy to fire back responses if she knows the answer to it, or put you in the direction of the right people, especially with specialists in certain areas of tax. But yeah, this is the first of many. We are planning to hopefully run one every month, a webinar on different aspects of your property investment journey. So feel free to send me a message, and also what you want to see in these webinar series. We would love that input to now make sure I'm giving you the best content and bringing the best partners onto our system and our platform. So Nicole, I just want to say a massive thank you for you and your time and doing this with us. And I appreciate you all for joining. And have a great rest of the Thursday the 5th, and we'll see you very soon.
Awesome. Thanks for having me.
All right, Nicole, I'll speak to you soon. Bye.
Bye.